What is going on, investors? Hopefully guys are doing well out there. Time to talk about Palantir Technologies, ticker symbol PLTR. This has to be one of the most overhyped stocks that I have seen here on YouTube, but also on sites like Seeking Alpha. Take a look at the last dozen or so articles that were written on this stock over the last few months. We've got buy, strong buy, buy, strong buy, strong buy. Everybody has been pumping this stock, and over the last year, it is down 49%. It's been one of the worst performing stocks that you possibly could have owned. We'll come over here and take a look at this from a technical perspective as it's pulling back to an IPO price back at about $10 per share. We'll talk about, is there demand for the shares at this level? And obviously, as the stock continues to pull back, now we have a $28 billion market cap on this one instead of it being much higher in the past. We'll talk about, is the valuation starting to make a little bit more sense, since if you've been following our channel, the valuation and this company's revenues have made absolutely no sense from a valuation perspective. We'll talk about when we get over to the revenues, the profits, all those types of things. We'll talk about, is it making a little bit more sense considering the stock price has just fallen off a cliff. Now, in terms of what's driving the stock today, the stock's down about 11% after reporting earnings. It seems like every time this company reports earnings, the stock just tanks, and Q4 was no rare exception. We had revenues coming in at $432 million. That was 34.4% year-over-year revenue growth. It did beat the expectations by about $14.73 million. Now, when we come over here to the financials, we'll see for the full year, the company did about $1.5 billion. Again, we have to remember this is a $28 billion market cap company. Maybe give them credit for another 30% revenue growth next year. You're sitting at about $2 billion worth of revenue. Still mildly overvalued, but certainly not where it was in the past when the stock was much higher than this. In terms of the upcoming quarter, so we got guidance for Q1. We're expecting revenues at $443 million. That was over consensus estimates at closer to about $440 million. Adjusted operating margins coming in at 23%. We'll talk about, when we look at this company, the fact that they've have incredibly high gross margins. And so I can understand some of the bull case arguments when we look at these financials. But in my opinion, the hype kind of got out up in front of this stock and certainly kind of got this stock out in front of its skis. And we've obviously seen it pull back, like a lot of stocks over the last few months or so. Now, the company is projecting annual revenue growth at about 30% or greater through 2025. That should increase the odds of this company actually turning a profit at some point. Now, I'm going to shrink this down a little bit, get us a little better view of this. Now, we come over here to the financials. I tell you what, if you've been watching YouTube videos about Palantir, I'm not going to tell you who to watch, what to watch, but if they're not bringing up the financials, if they're not breaking these down for you, I don't know exactly what value they're actually doing for you, instead of just basically overhyping a stock that is down over 50% over the last year. So we're going to dive into these numbers. If this is something that you have not seen before, you need to really start bringing these up before you invest in these very speculative companies like Palantir. We had revenues, like we talked about, $432 million worth of revenues. That was 34% year-over-year growth. We see that here. We went from 322 last year all the way up to 432. You see, for the full year, you went from about 1.1 billion up to about 1.5 billion. Now, what I love about this company, and I've never ever criticized about this company, and in fact, this is why we continue to cover this company, because there actually is some stuff here. This cost of revenue, look at this, only $87 million. So you only had to spend $87 million to make this 432. That gives you gross profit of $345 million. These are some of the highest gross profits I have seen in the stock market, quite frankly. Take a look at, for the year end, off of $1.5 billion worth of revenue, you clear to the gross margin side $1.2 billion. Now, wouldn't it be awesome if that was it? Those were our only costs. Well, I think some people that are overhyping this stock, they actually stop right here. And I can understand that. There's an argument to be made here, but unfortunately, that's not the full story. We've got other operating expenses over at Palantir. We've got sales and marketing that went from 147 up to 162. When you look at a company like this, I think you can imagine this company is not making money. When you look at the stock chart of this company, if they were making money, it would probably be doing the reverse. And so when a company is not making money, what we want to see is these operating expenses start to flatten out, because the company has given us guidance that they're going to grow their revenues by 30%. So you can model that out. You could take take the revenue that they just did, 1.5 billion, and be conservative, and then add another 30% for 2022, add another 30% for 2023. I mean, they modeled this all the way out to 2025. So we know within a certain reason where their revenues and to a certain degree where their gross margins are going to be 4 years out. What you want to see with Palantir is they start flattening out these operating expenses, and we actually saw that in the most recent quarter. Take a look at this. We went from 408 down to 404. This is exactly what you should have been waiting for with Palantir. Instead of jumping into this stock, you could have waited until these operating expenses started to flatten out, because look what it did from this loss from operations perspective. We went from a loss from operations perspective last year at 156. It improved. We're not positive on our income from operations, and I think you could probably potentially even wait to invest in Palantir until they actually start turning a profit. Right now on a quarterly basis, they're losing about $58 million. It looks like to me, if they continue this cost structure, they're actually at a tipping point. Within the next 2 to 3 to 4 quarters, they're likely to be either cash flow even or maybe a small net gain on their income from operations. You see, over the last year, paints a very similar story as well. You went from a $1.1 billion loss last year. This is when we were making videos here on the channel saying we don't like this stock. These are negative trends from an operating perspective. Well, they're starting to turn the corner a little bit. They're not great, but they're a heck of a lot better when in the most recent year, you lost just $411 million. Now, what some bulls are going to argue is a lot of these costs or some of these costs are stock-based compensation, but we're actually seeing a more increasing of cash being used. You see here in 2020 on a quarterly basis, total stock-based compensation based on these costs, your sales and marketing, general administrative, and your research and development cost, that total was 408. Of that 408 million, 241 million was actually not cash. It was actually shares of Palantir. Now you see for the most recent quarter that we just did, we have almost identical amount of operating expenses. In fact, it went down by about 4 million. It went from 408 down to 404. But notice where stock-based compensation went down considerably, down to 166 million. So what does that tell you? They're obviously compensating their employees a little bit less from a stock-based compensation perspective, but they're having to use more cash, okay? As your stock does this, your employees and attracting good ones and retaining them, you might have to start giving them cash because obviously they've seen the value of the shares that you awarded them last year decline by about 50%. And so there's kind of a catch-22 when it comes to share-based compensation. When your shares are doing well and the employees want them and they desire them, sure, it's a good substitute for cash. But when your stock has been absolutely decimated like Palantir's has, well, guess what? You're going to have to reward your employees with more cash compensation than stock-based compensation. And we've certainly seen that over the last year in terms of what Palantir's done. Now, in terms of their balance sheet, looks really good, okay? They still have about $2.2 billion worth of cash. It's a company that hasn't been around that long, and they don't really have a lot of debt. And so they've done a really nice job over at Palantir. This is about as crystal clean balance sheet as you can get. So you don't necessarily have to worry about this at the current time, okay? And on top of that, it looks like they're starting to move in the right direction from a cost perspective. Now let's come down here to cash flows, because some of you might be saying, well, this company awards a lot of stock-based compensation, and you would be absolutely correct. Here it is from a cash flow perspective. Last year, you awarded executives and employees $1.2 billion. Yeah, $1.2 billion worth of cash-based, stock-based compensation last year on $1 billion worth of revenue. So does that make a lot of sense? Not really. And that's also another reason why I've recommended avoiding this stock in the last year or so. Now, things are still not great, okay? We awarded $778 million worth of stock-based compensation off of $1.5 billion worth of revenue. And obviously you come down to loss from operations. It's exceeding that. We basically gave away 50% of our revenues in terms of stock-based compensation. So it still doesn't make a lot of sense from that sense to me, but from a cash flow perspective, things have gotten a lot better. Okay, you pull down this net loss of 520, you get to add back in this mammoth stock-based compensation. You come down here and cash flows have actually turned positive. That is absolutely great for this company because you went from negative 300 million last year all the way up to a positive 330 $43 million. Now, they're still exercising common stock options. They've tapped this stock a lot. That's why this balance sheet looks really good, is because they've used this stock basically as an ATM in terms of raising money for the company, but also compensating employees as well. And so, look, there's some things I actually like a lot better about Palantir's financials right now. The fact that their costs have actually flattened out over the last quarter, and on a yearly basis actually went down considerably from 1.9 billion down to 1.6 billion. I still think this stock-based compensation is egregious, but as this stock continues to hang down here in under about $18 per share and continues to perform poorly, it's going to be difficult for this company to continue to attract and retain talent with a stock that is not performing. So they're going to have to get this thing turned around if they're going to want to continue to use that. Otherwise, they are going to have to burn through a little bit more cash compensation, and that could impact the balance sheet at some time, but I don't necessarily think that time is coming anytime soon with Palantir, all things being considered pretty strong from a balance sheet perspective, and things are improving from an operating perspective. Now, hopefully, in fact, most of you that are watching, if you own this stock, you are considered a bag holder on this one, especially if you bought it over this area of support that we identified a while ago at $18 per share. Once this stock broke through $18, I mean, it tried to hold this level. This stock was defended pretty nicely at 18, and I was actually pretty surprised when it broke down. It was going to get ugly, and here we are sitting all the way down here at $12 per share. There is some support for the shares, but unfortunately, it's all the way down here at about under $10 per share. I think your upside in this one, so some of you are wondering, should I buy the dip on this one? Should I average into this one? Should you dollar cost average into this one? Understand your upside is probably back up here to 18, okay? Because this area at 18 was an area of support here. It was a significant area of support back in December. And then once we broke down through that, then now it acts as resistance on the way back up. So even if we put up some green candles on this one, I would expect us to meet some resistance back up here at 18. But look, it's a $12 stock. It goes to 18. That's a 50% rise in this one. Okay, so if you want to play that from a technical perspective, I could understand that. Just understand as well, your downside is back down to probably back down to $9 per share on this one, maybe even $8 per share. So you've got about $4 in downside on this one at the current price, and you've got a little bit higher than that, about $6 in upside on this one. It was in the shorter term. This one looked like it was starting to reverse a little bit. You were creating some smaller sets of higher sets of lows here, but unfortunately after reporting earnings, that kind of wiped that out. But there appears to be some support for the shares right here at $12 per share at a $28 billion market cap and growing your revenues over the next 3 to 5 years, 30% or more. There's some argument to be made that they'll be able to grow into this $28 billion valuation. Now, what we'd probably want a little bit more clarity on, are these costs going to retain at this $400 million level? Because if they do, this company is likely to turn a profit, at least from an operating perspective, here very soon. And so there's some things to like about this stock, but look, if you're in this stock, if you bought into the hype here on YouTube, Seeking Alpha, anywhere out there, just understand with these speculative stocks, you can almost always take your time, especially with not a public facing. This wasn't a Tesla where you could get out and drive the car. It's not an Amazon where you get the packages delivered to you. Sit around a table of 20 people and talk to them about Palantir, and nobody's going to know what this company does. And so there is some of that as well. And I know that's not anything traditional valuation perspective or anything traditional fundamental basis, but there is something to that. When you have consumer facing companies, I've seen a lot of people compare Palantir to Tesla and Amazon. Nobody knows what Palantir does. And so you can be patient into this one. I would wait for this one to find its footing down here at the $12 level. I wouldn't necessarily jump in here at these levels because the sentiment in this stock in the longer term is still down. We're making lower sets of highs all the way around. And in fact, we just confirmed that more recently, that these highs at $14 was another lower set of highs that were up here at 19, and the other initial set was up here at 27. I would wait to see how this one bottoms out. It wouldn't surprise me if it comes down here and tests the $10 to $9 range. That is where the valuation could make even more sense, especially considering this growth rate. There's some things we like about Palantir. The fact that the stock price has pulled back so much is starting to make this one look way more attractive than it did a year ago. If you are in this one and you've lost a lot of money, take lessons from this. Make sure you do your own due diligence and maybe draw the line on not investing in companies that were this wildly unprofitable last year and even parts of this year. Wait till they start turn things around. My best advice is actually wait until these loss from operations turn positive. To be quite frank, the stock could be even lower than that when this company finally turns a profit. That is when Palantir could actually be a strong buy. Hopefully you guys enjoyed this video. Be back again soon with more. Good luck with your investments.